Hi. So now we are starting with portfolio management, and portfolio management has a very small percentage of weight, but has too many things to read. So too many theoretical topics here, but it's going to be very interesting. So practical content relatively less, but do not on the theory. Do not get bored with the theory. That's very interesting. I've put a lot of charts and graphs for your references. And so do enjoy the session of portfolio. Let's join in. Yes. Okay. Welcome everyone. So now we are going to begin with portfolio management. Well, if you see the proportion of portfolio management in your syllabus, it's around 5 to 8%, and that's the least, and it's almost equivalent to alternatives and derivatives. Well, in derivatives, you just have 2 readings. In alternative, you just have 1 reading. Compare that with portfolio, you have, as of now, 7 readings in portfolio. Now 7 readings for a percentage of 5 to 8. So how many questions do I expect from portfolio overall? If you notice here, it's going to be around 10 to 12 questions on an average that you'll get from portfolio, or maximum 14 questions. And for that, you have 7 readings. So, when it comes to efforts that you have to put in proportion to the weights that is required in the portfolio, it's tremendously high. And in fact, in the new curriculum that's going to come in 2022, you have 1 more reading that they've added into it. So there's too much to ask for when it comes to portfolio. Now, in most of the other syllabus where I've taught portfolio, like chartered accountancy and other, financial courses, the portfolio was more of practical thing. There were too many questions to be solved. However, in CFA, by now, if you have noticed, we have at least equal, I can say, proportion of theory when compared to the practical questions. In fact, if you dwell deep into this, except few subjects like QM, you'll mostly find theoretical topics dominating the practical topics, right? So all those who generally tell me that, why should I not do practical more? Should I not do theoretical more? Let me tell you, or let me remind you that the practical questions are relatively less compared to the theoretical content. The theoretical content is more. And as per the recent exams, which a few of my students gave, they told me that, one of the student had previously given the exam from somewhere, and then she joined me, and then recently she gave up an exam, and she told me that, what the trend that she saw, because she had given the old structure exam and now she gave the new structure exam. So she said me that, perhaps that there was a very tactical shift in the way that more theoretical questions were asked. So do not get bored with the theoretical part here. Institute has a knack of asking more of the theory questions, right? So the reason we are getting deep into the theory, we're trying to understand the logical aspect of it, it's because it is equally asked in CFA exams. It's not like any other exams where the theory portion is around 8 to 10% compared to the practical. So do not underestimate the conceptual part in CFA at all. Okay. So with that thing, let us start with the first reading that we are going to do, portfolio management and overview. Now it's just officially they've named an overview, and that is what it is. It's an overview of portfolio management. First of all, what is portfolio? When I hear the word portfolio, the first thing that comes to my mind, it's not an individual security, it's a basket of securities, correct? So portfolio is always basket of securities. Why do people create portfolio? Why don't they put all their eggs in one basket? Why don't they invest everything in one investments? I mean, look out at your parents, look out at your investments of families, even though they have not done CFA, right? They have not done any other financial course, but they know that basic concept of diversification is that they don't put all their money in particular asset. They spread their investments. And that biggest reason behind that is to
diversify.
Reduce risk.
But tell me one thing honestly, which I used to always wonder, that if someone has made millions of money by investing in their own business, why do they still require financial advisors? Why someone does require a financial advice? And well, if you think that you don't require a financial advice, then why is that such a big investment advisory business or investment management business? Because there is one inherent question that we all have, is that first, it's not that we don't want to invest, right? We all want to invest, whether it's an individual or whether it's an institution. Everyone faces one common challenge. First is how to invest. By how, I don't mean opening up an account and all. It's a process of investing which is more important. Individuals have goals like retirement, their education, their children's education, and so on. In many countries, education is free, but we are not that fortunate that we do have to pay a huge cost of education, right? So individuals may have several goals, and those goals can be short-term and long-term. Institutions also have some financial goals, like pension funds or insurance companies. They have to pay back to their policy holders. They have to pay back to the ones who have invested in them, right? So they need pension funds. They need to pay back the retirement amount. Insurance companies may have to pay back on if there is a claim settlement. So everyone has some financial objectives to be achieved, right? There are endowments. Endowments are non-profit institutions like charitable trusts, which we call in our country. You have universities in US, which are called as endowments. They raise funds which they spend for their research and for their education activities. Correct. So there are individual as well as institutional investors. And what are the challenges that they face? As I said, the first thing is how to invest. Second, where to invest, what asset classes that I need to put my money into, right? So how to think about investments, what asset classes that I should put in my investments. Should we invest in individual security? And if you want to invest in individual security, then you will have to think in, first of all, even if you don't want to invest in individual security, should you only think from an individual security point of view when you're investing, or should you take a portfolio approach? Now, that's what our center point is, taking a portfolio approach. For example, tell me one thing, investing in real estate, risky or not? Yes?
Yes.
Risky.
Risky. Investment in Bitcoins?
Super risky.
Yes.
Super risky. But if you think individually, it's riskier. But tell me one thing, what if its correlation is negative to your existing investment portfolio, which may be, let's say, into equities or which may be into fixed income bonds? In such case, if I look from the portfolio point of view, I think your portfolio's risk is not increasing, because having a negative correlation actually reduces your overall portfolio. So looking from an individual point of view, you will find assets risky and less risky. But you always have to look it from the overall portfolio point of view. You have to look at, when I add the security in the portfolio, is that going to increase or decrease my risk? That is called portfolio approach of investing. That is called portfolio way of investing. So portfolio perspective of investing is taking the portfolio approach, which is evaluating individual securities in relation to their contribution in the portfolio, not only in terms of return, but also in terms of risk. So whether it increases the overall portfolio risk or reduces it. I'll repeat, whether it increases the overall portfolio risk or it reduces it. Definitely, if adding that security is going to reduce my portfolio risk, then it is worth investing into it, irrespective whether individually it is riskier or not. And we've learned that in quants, that aspect of the securities risk in the portfolio, that is measured by a factor called covariance or correlation. And if you recollect, which stock should I have? Positive correlation or negative correlation stocks? I should have stocks with as low correlation as possible. You recollecting that, everyone? Correct?
Yeah.
And that is what is diversification. So diversification is the key for us to invest. Now, many of us have done diversification by, let's say, investing money in equities and investing money in bonds. That is diversification, yes or no?
Yes.
But tell me, if I invest my money in, let's say, equity issued by Tesla, and I also invest my money in the bond issued by Tesla, am I actually diversified?
Yes.
I'm not diversified. because I'm investing in the same company's equity and debt. Diversification is just not, what should I say? Diversification is just not having different colors of ice cream. It's having different flavors of ice cream. Are you getting me? So having different colors and having different flavors is a very different thing. Clear? So having just equity and bonds is not diversification. You need to check whether they actually go in tandem or opposite. Now, many people who work in government companies or in public sector undertakings, or even in large private corporates, they work there for, let's say, 10-20 years, and over the period, then they become so loyal to the company that they start investing in the same company itself. Correct? So you have pension funds where you have a choice. I will discuss with you what are the two different types of pension funds. But one of the pension fund, which is called a DC plan, defined contribution. In that pension fund, you have a choice of where you want to put your money. Not the employer, the employee has a choice. So there happened a case with Enron, one of the biggest fraud in American history. In that case, when the employees had been given the choice of investing their pension money, most of them had put their money back in the company's equity itself. So what happened when the fraud came out? People lost their jobs and also lost all their retirement savings because the company went bankrupt. Are you getting me? So that's not diversification. Diversification is not investing yourself in the same company and your money also in the same company. That's not diversification. Diversification is not when you invest in the bonds and equities of the same or similar type of companies. Diversification is not having two different types of equities when just two different type of equity. That's not diversification. It does give you some form of diversification, but you need to check the correlation between those investments. For example, in many countries where the housing sector is a big investment, for example, let's say in the Middle East, real estate is a much bigger market. And in those countries, we have immigrants, which also create huge demand and supply for the properties, right? But tell me, if during the times of crisis, what will happen to the immigrants? Will they stay in the foreign land or will they rush back to save their rents? What do you think?
Migrate.
Sorry?
They will migrate back.
They'll migrate back, right? So in such a case, the economic or financial crisis will happen in a country and the real estate market will also crash. That's what happened with Dubai into the 2007-8 crisis. The financial economy also crashed and the real estate market also crashed. So having invested into real estate and equity especially in terms of crisis, does not provide you diversification. Diversification's objective is to avoid disaster, and avoiding disaster is just not by investing in two different types of securities, but actually investing in securities where the risk characteristics are completely opposite or not related. And that's not an easy task. That's what we are going to learn here. Clear? So as I said, in Enron, people had invested that 401k amount in the Enron stocks and they lost their retirement corpus as well as their jobs. What is 401k? It's a tax advantage DC, defined contribution retirement plan, which is offered by employer to employee in US, in various nations. They have different names. I'll discuss that, what is the name in India as well about it, right, in a while. So these are retirement funds. So that is one aspect, that portfolios diversification is is important from the point of view of avoiding disaster. Now, my objective is to reduce the risk, but by reducing the risk, the return should also increase or decrease?
Decrease.
Returns decrease, right? So if I go to an investment analyst and if I tell that investment analyst that, you know what, I need to reduce the risk of my portfolio. And if that investment analyst tells me that, yes, for that, you will have to reduce your returns also, then definitely I'm going to say goodbye to him. Why? Because that even I know. So who's an investment expert? The one who knows how to reduce the risk without compromising the returns. That is what I call not just as a skill, but an art. Okay. So we all know that higher the risk, higher the return, lower the risk, lower the return. But someone who can manage the risk and give me potentially higher returns, that's what portfolio manager, that's the portfolio manager that I'm looking for. So the objective is to reduce the risk. Rational investors are concerned about the risk return trade-off, and they do want to reduce the risk. They want to go away from the risky investments. By taking a diversified portfolio approach, investors can, if not reduce the risk, spread the risk. Some of the risk, if not all the risk. The portfolio approach provides investors with a way to reduce the risk associated with the wealth without necessarily decreasing their expected returns. So this is portfolio approach. Portfolio approach is an approach where the portfolio's risk can be reduced without actually compromising too much on the returns. This aspect or the skill or art of the portfolio is what I call as diversification. But how do I know how much am I diversified? How do I know how much am I diversified? Well, for that, I can't just say that, investing in A and B is diversification. No, I need to statistically measure diversification, and that is through some statistical aspects like standard deviation. Standard deviation tells me risk, correct? So standard deviation of an individual security or the portfolio tells me the risk. But it still does not tell me whether the risk is high or low, and therefore we check the diversification ratio. Diversification ratio, although not precise, is one of the ways of checking the diversification. Let's say you have 10 stocks and you have invested in all of them equally. So what is your weight in all of them? 1/10, correct? So if you've invested equal amount in all of them, can I say the risk will be equally divided between all of them?
Yes.
So the overall portfolio weighted average risk will be equal to the individual security risk, isn't it?
Yes.
I repeat.
Yes.
The overall portfolio risk, which is the weighted average of all the securities, will be the same as all individual securities, isn't it? Because I've put equal weights. Correct? So diversification ratio is the ratio of, it's a ratio of risk. What risk? Standard deviation of portfolio of equally weighted stocks. Standard deviation of portfolio of equally weighted stocks. Divide by the standard deviation of a security that you're willing to add or you have added. Let's say security X, Y, Z, A, B, C, or anything. So if I say, let's say the standard deviation of the security that I'm planning to input is 20%, right? And the standard deviation of the portfolio is also 20%. Tell me, what do you think about this security? If I add this security into my portfolio, will it change the risk? Will it change the risk or not? If I add equal amount of this security in my portfolio, will it change any risk of my portfolio? My existing average risk is 20 and the security that I'm looking also has a 20 risk. Does it change the equation of my portfolio?
No.
No.
Therefore, if in this case, the diversification ratio is 1, when the diversification ratio is 1, it means there is no benefit of diversification. But what if I say the portfolios, the standard deviation of the overall portfolio, let's say is 20, right? And I'll put the standard deviation of the security that I'm planning to input as 30. What does it tell me? It tells me that the security individually is how much riskier? 30.
30.
Sorry?
30.
No, 30.
Individually, the security is riskier. Now listen to me carefully. But if that security becomes a part of the portfolio, the portfolio's overall risk is 20. So what is happening here? If I individually put my money in the security, how much is the risk?
30.
30.
But if I inculcate that security in my portfolio, the portfolio's risk is still 20. Does it mean that I should add the security into portfolio, or should I invest individually?
Add.
Add that, right? So in this case, my diversification ratio will be low.
More than one.
1. But now see this. So first of all, this is a good sign, right? This is a good sign that it tells me that the security is improvising on the risk if added in the portfolio. Now look at the opposite way. Individually, the stock is riskier at 30%. And now when I put that in the portfolio's risk actually does not decrease but increase. Now that rarely happens, but let me tell you that becomes 35. So in such a case, adding the security in my portfolio is actually increasing the overall portfolio risk. This is a situation that, first of all, it rarely happens. And if it does happen, then I should not go ahead with such a combination. Clear, everyone?
Yes.
So the worst thing, as far as we know from the portfolio properties, the worst thing that can happen is that either the diversification ratio is 1 or less than 1. At any time the ratio is less than 1, we will add that security in the portfolio or not add? Add that security in the portfolio, because when added in the portfolio, the security becomes less riskier. The overall risk does not increase. Clear? But there is one problem here. What is that one problem? What is that one problem? What is the assumption that I've used here? The assumption that I've used is that all the securities in the portfolio have
Equal
weight. Now that's an assumption. So one advantage of this diversification ratio is that it quickly tells you that the security, adding the security in the portfolio will help the diversification or not. But the disadvantage here is that I have taken equal weights. Now, in reality, instead of taking equal weights, we should take appropriate weights with the help of, you can use, if there are 2 or 3 securities, you can do it in financial calculator or manually also. But if there are tens of securities, then probably you can use the help of algorithms or spreadsheets, correct? So you can use computer optimization techniques to calculate portfolio weights that will produce the lowest portfolio risk. So weights here, instead of taking equal weights, you can also take weights using the computer spreadsheet techniques, and that will tell you what is the appropriate weight that you should do. That weight is actually defined as minimum variance portfolio. Now that's not a part of syllabus here, but let me just tell you that is called minimum variance portfolio. It's a weight which gives you minimum risk, and that is done by optimization or through the simulation techniques of computer. Clear? Just for simplicity, we use here equal weights. Otherwise, in real life, we use a more scientific approach. Correct, everyone? Clear with what is diversification?
Yes.
Now, tell me one thing, is diversification a concept which is new to the world?
No.
It's from ages, right? So we all knew that we have to diversify, correct? But we didn't knew how much and what is the measurement of diversification. The one which brought this into the picture, that guy is Professor Harry Markowitz. He was the father of introducing this concept of diversification into the field of finance and help understand several measurements of diversification. That theory was called the Markowitz theory, which is published in a paper in an article in 1952. The actual theory underlying the basic concept of diversification and its application to investment only emerged in 1952 with the publication of Harry Markowitz's classic article on portfolio selection. Now, the first time he published that article, that became a rage in the market at that time, because that's where diversification so well elaborated. And it was not only elaborated in terms of, what is diversification. Basically, there are a lot of things that he had input, the lot of statistical measures that he had input, which then became, the basis of what we know is modern portfolio theory. Modern portfolio theory, what is modern portfolio theory? I'll just come back to that in a while. But his contribution in the field of statistics and diversification gave an input, gave fuel to the fire of modern portfolio theory, right? That is Professor Harry Markowitz. Professor Harry Markowitz is a finance professor at university in US, and he has enormous contribution in the modern portfolio theory, understanding the risk returns and the correlation and diversification aspect. That's what he's written a lot of things about, right? No wonder he's got one of the most prestigious prize, that is Nobel Prize in Economics, and and he's got various other prizes to his name, and that's what Professor Harry Markowitz is. Let me tell you, he is what can I say? He's almost 95, 97 plus, if I'm not wrong, and he is still alive. As per as what I'd read, he still teaches at the the institutes of this particular San Diego. So he does still teach, and that's what Professor Harry Markowitz is. So he's still very much alive, and that's what his contribution to the field of finances. So all that you probably see, correlation, covariance, and its application in finance, this is the guy that you need to blame to make your finance more difficult. Okay. So that's what Harry Markowitz is. Now, the work done by Harry Markowitz, where I see that he was the first to introduce the concepts of modern portfolio theory and the concept of diversification, to be more precise. He threw the light on what exactly diversification is through his scientific approach and his mean variance portfolio theory, where he described that how to reduce the portfolio risk by having negative correlation stocks or by having optimum weights. That's what he proposed. Now that part was being further taken by various other analysts, like various other economists, like Professor William Sharpe, Jack Tranor, and John Dinter. These guys worked on the modern portfolio theory, and then they came up with various economic theory, which we are going to see in particularly our syllabus, which we have already seen in terms of equity, like CAPM, capital asset pricing model, which was derived by William Sharpe. And the basis of capital asset pricing model, which was beta, the sensitivity, which actually is a part of the work done by various other economists, including Harry Markowitz. So professors who contributed to the diversification aspect of portfolio, these are the professors using the framework of Harry Markowitz. The main conclusion of this theory, modern portfolio theory, is very important. Traditionally, we believe that to increase the returns, you need to increase the risk, right? But modern portfolio theory tells us that an investment's risk and return characteristics first should not be viewed in isolation. You should always look from the portfolio approach or portfolio point of view, right? So an individual an asset or a security may be riskier, but when added in the portfolio, does it increase the risk or reduce the risk? That is what we need to check, right? So it should not be viewed alone, but should be evaluated in terms of overall portfolio and how it affects the overall risk and return of the portfolio. That is first. Second, what did they conclude? The conclusion that diversification allows the investors to increase the risk or reduce the risk?
Reduce the risk.
Reduce the risk without necessarily compromising on returns. So they will help us reduce the risk necessarily without necessarily reducing the portfolio's expected returns. That's the second most important thing that this theory helps me. And the third that this theory helps me is to derive what should I expect from the equity? What should I expect from the risky investments? Well, I know when I invest in risk-free security, I need risk-free returns. But when I invest in risky security, how much riskier it is, and based on that risk, what is the risk premium I require? What is risk premium, guys? Risk premium is the extra return or excess return that you require over and above the risk-free rate. Why? Because for the compensation of risk in the asset, you have the chance of losing money. That's what, for that you require the risk premium. Clear? So three things that this modern portfolio theory helps me to. First, anyone?
Diversification.
Yes.
That I should not view investments or risk return in isolation. I should look it from the portfolio point of view. Second, with the help of diversification, I can reduce my portfolio risk without necessarily
Reducing the expected.
And the third, it helps me in identifying what is the minimum return that I should expect from the stock, like CAPM equation. Clear, everyone? Right? That's what the modern portfolio theory is all about. So what are the steps in portfolio management? First, let's assume that you're working in the portfolio management company. So you are handling clients and their portfolios. Tell me, before I move to what are the different types of clients that you have? Those are different types of investors that you will be dealing with. But whatsoever type of investors you are going to deal with, what is the first thing that you will do when you see a client or you have a client's portfolio in front of you? How will you process it? The first thing is that you need to sit with the client and plan. You first sit with the client, understand the client's needs, the client's objectives, the client's constraints, the client's problems, the client's opportunities. You understand that. That's called the planning step. So there are various steps to execute the portfolio management process. The first is the planning step, understanding the client's needs. And do I just hear the client's needs and say, okay, yeah, good, I'll see? No, I need to document that. The documentation of clients' risk return expectations, the documents of the client's objectives, the client's constraints. We will see what are objectives and constraints in detail in a while. So all those things I need to document in a particular, you can say, it's like a contract or it's an agreement between me and the client. That document is what we call as investment policy statement. So you need to have a formal plan, formal written plan, which is signed by both the investor and the one who's going to manage the fund, right? So the first you do the planning of what you consult with the client and with your team, what exactly should be the process of managing the investments. And second, based on that consensus, you do sign a written agreement with the client that is called IPS, investment policy statement. What is the importance of IPS? Tomorrow, what happens? Let's say if I move the job and if I give this fund to someone else to manage it, will the new guy again do the meeting with the client and do the entire process of discussing with the client? Is it feasible?
No.
How do people work when they join a new company and they work on existing clients? They open up the file. They open up the file of the client and they see, okay, what is the process? Who was handling what? How was it being handled? And people follow it, right? So it serves as a guidebook for every person who's going to work on it. Second, tomorrow, neither me nor the client can, move back from their words. So if there is any discrepancy, then probably we can have this as a reference for any issues. Clear? So that's what the first step is. First step is understanding the client's needs and preparing a written document, that is IPS. That comes under the planning step. Clear, everyone? This planning step will actually give you an indication like, deciding on which road you want to travel with. It's like choosing a map. Once you have finalized the map or the GPS, now you start the engine of the car. That's called the execution process. The execution process is basically the client is gone. Now you have to execute as a portfolio manager. Now, first you will have to decide based on the client's requirement or which I will get from IPS. Where do I need to put the money? And where do I need to put the money? First of all, I need to ask the question, what type of assets I need to have in the client's portfolio? So I need to know the asset allocation, debt, equity, alternative investments, real estate, what not, and what should I put, and in what proportion. That's called asset allocation. Here, I can use a top-down or a bottom-up approach. Top-down approach is that I start first from the economy, then I go to the sectors and then the industry, and in that way, I will evaluate which all asset classes that I need to put. In the bottom-up approach, I may start from the bottom, that is, I may start from company analysis and then may scale up to the economy analysis. Correct? So various approaches I can use to decide on which asset classes I want to put my money and in what proportion. Clear? Of course, here, if the client is, let's say, if the client is of an old age, then probably more of my money will be in the alternative investments, right? It will
No.
be in funds, right?
No.
Then it's going to be into
Like fixed. Fixed.
alternative securities, correct? Naturally. We have several rules here. One of the funniest but effective rule is 100 minus age rule. Have you heard about it? 100 minus age. Let's say my age is 35 and 100 minus 35. So 65% of my money should be in equity, 35 should be in debt. The more I proceed in life, the more of my allocation will go into move from dash to dash, move from
Security to debt.
equity to debt. That's one of the thumb rule that people follow. And there has been data to say that that has worked. So, and in fact there are funds which invest in that thumb rule. So it's not nothing wrong in the way. So you should have a policy of deciding how to do the asset allocation. Once you've decided the asset allocation, then within those assets you need to shortlist the securities where you need to put the money. For example, if you shortlisted bonds, are you going to put more of your bonds investments into high yield bonds or investment grade bonds? In equities, are you going to put more of your money into particular sector, or are you going to diversify? That's going to be with respect to security analysis. And finally, you will construct a portfolio based on the client's objective of risk and return. You will ensure that the portfolio never exceeds the client's risk tolerance. You have to be in consensus with the IPS. So decisions have to be taken with respect to diversification and weighings and all. Manage risk as per the risk tolerance of the client IPS. That's the process in execution. So 3 things in execution. First, asset allocation, deciding on which assets to buy and how much. Within those assets, security selection, which type of securities should I pick up? And during this process, I need to check into account that my portfolio construction does not exceed the risk tolerance that my client has set. Correct. That's what the execution process is. Clear?
Yes.
So planning and execution is done. Understand one thing. Execution is basically, practically, if I would say, is actually deciding about pressing that enter button on your computer. You know what happens with the enter button? It's a go signal that you start the car. Your investment is taken. But while you were investing, at that time, you had seen the client's circumstances, needs, and the market conditions, and accordingly you put your money, right? But both of these things are bound to change. After a while, there is a need for checking up with the existing plan. That's called the feedback step. In the feedback step, the first thing comes is portfolio monitoring and rebalancing. As I said, both of these things will change in the future. What? The client's need and circumstances and the market conditions. In either of that, I may have to redesign a portfolio or reshuffle my portfolio, which is what we call as rebalancing. Correct? For example, if the client's financial situation has improved, then I may put more of money into equity. Correct? Or I may remove more of the money from risky-free assets. Right? I may add some alternative investments. That's what I may do if the client's situation improves, and opposite I'll do when the situation deteriorates. On the other end, if I feel the markets are very risky, so temporarily I may move, even the client's condition has not changed. But if the markets are very riskier, then I may move clients' investments from risky assets to liquid assets for a while. So that's what I will have to constantly do it. And that's why we say portfolio management is not a one-day job. It's not a one-time job. It's a dynamic process. Clear? And finally, the last thing comes is the performance measurement. You need to communicate with your client and display the clients whether you have been able to achieve the client's objective of risk and return, and that too in a simpler manner. So that has to be reviewed regularly so that you are in sync with the client's IPS. Clear, everyone? 3 steps: planning, execution, and feedback step. Everyone clear with that portfolio management process?
Yes.
So that's going to be your job profile when you are in the PMS, portfolio management service. So what are the types of clients or investors that you're going to come across? Well, if you are in a boutique firm, in a small unit, you will mostly have individual clients. But if you're in a large investment bank, then you may have not only individual clients, but institutional investors. So let's discuss about both of them, individual investors and institutional investors. Individual investors are basically those like you and me who invest for our short-term and long-term goals. Short-term goals, as I've said in the past, can be with respect to buying a home, buying a car, for my education, for my children's education, and so many goals. What are my long-term goals? My long-term goals are probably after 25, 30 years, like having a retirement, having a second home, having, probably, having setting up of enough corpus for donations, or starting up my own political party, right? Or standing up for election. That's what my long-term goals will be or are. Okay. So these are all my long-term goals. So for long-term investments, for long-term goals, I'll do long-term investment, and for short-term goals, we'll accordingly work with the client's IPS. This is what individual investors, perhaps, they have their way of investing, and those are the types of individual investments that you come across. The another type is DC plan. Now, I just discussed with you all DC, defined contribution. There are two types of pension plans. One is a DC plan and another is a DB plan. DC is defined contribution and DB is defined benefit. Right now, we are focusing in defined contribution because in defined contribution, the employer and the employee both contribute. In US, that is called 401k. I'm sure you must have heard this. So here the employer and the employee both contribute in the pension fund, correct? But where to invest? This is the selection given to the employees.
Yes, employees.
So the investors here, the employees who are basically going to receive this corpus on their retirement, they are the one who accept the investment risk. So under the DC plan, who has the choice to select the schemes or select the investments?
Employee.
So they bear the risk. So employees will decide where to put their money. So if they get more money, it's all theirs. If they lose, that's there. Contrary to this, defined benefit is a plan where the government has promised you a fixed payment irrespective of whatsoever. So in such a case, why am I saying government? Because most of the DB plan, defined benefit plans, are by government. You can assume your employer. So in a defined benefit plan, contrary to DC plan, who bears the investment risk? Employer or employee?
Employer.
Employer. So employer bears the risk of reinvestment. Employer bears the risk that if something goes wrong, so employer has to create a pool of investment so that the employer can fund the future liability. That's called planned assets. So employer has assets which should grow enough to repay the liabilities. And anytime the value of liabilities is more than asset, we say it's an underfunded plan. What do we say?
Underfunded plan.
Underfunded. So let's say today everyone retires, then I will have less money to pay the retirement amount, then I may have to contribute more. But if the plan assets are more than the liabilities, then we say it's an overfunded plan. All the employers want the fund, the investments to be overfunded, that they want plan assets to be more than liability. However, this is the headache of employer, not the employee. Employees, rest assured that, oh, I am defined my money. Most of the government employees get DC plan or DB plan?
Benefit.
Defined benefit plan, correct. But just think like an employer for a while. As an employee, what is good for you? DV, defined benefit, is good for you, right? But from the employer's point of view, this is very risky, isn't it?
Yes.
Hence, forget private companies have DC plans, but even government companies have now started coming up with not DB plan but DC plan. For example, in India we have National Pension Scheme. Have you heard about it? NPS. That's a plan that the central government came up with. So all those employees who joined the central government after January 1st, 2004, they all are now under the NPS, which is a defined contribution plan and not a defined benefit plan. Are you aware about this? People know that NPS is a good scheme, but they don't know the fact that it's a DC plan, not a DB plan. Clear? So now many people join government jobs for pension, right?
Yes.
Correct. In fact, in our country, many people marry their daughters and sisters with, we had a trend before with those who have government jobs because of a secured retirement benefit, isn't it? I don't know what was secured in that, by the way, but still, correct?
Yes, sir.
Now that's not going to be the case, because now you have NPS where it's a DC plan. The risk is with the employee. Clear, everyone? DC plan and DB plan.
Yes.
So in DC plan, who decides where to invest?
Employee.
Individual or the employer?
Employee.
Employee, that's the individual, right? Therefore, it's a part of individual investors. But in the DB plan, defined benefit, it's the company which decides where do I have to put the entire money for. Therefore, that's called the institutional investments. That comes under the institutional investor. Is that clear, everyone?
Yes.
Now, the second type of institutional investors that you may come across are endowments and foundations. Now, endowment and foundations these are basically non-profit organizations. Basically, in US, there's a trend of having endowment funds. Endowments means donations. They collect donations, which they use it for their funding activities. Like it is common in US universities to have large endowments, but it is somewhat less common else in the world. This money is used as a continual financial support to universities and their students. Most of the top universities of the world, they give scholarship to students, right? But they also collect hefty fees. So they run a lot of research related activities. They promote a lot of R&D. That's where they use this fund. Clear? So therefore, they have the endowment fund, the world's largest endowment fund. It's not surprising that Harvard University has in fact, I should say the world's largest endowment fund, and they have a corpus of $40 billion approximately. Can you believe that? Harvard University, which is one of the world's oldest universities, probably 500, 600 years old, if I'm not wrong. They have a corpus of $40 billion. Can you believe? Which is managed by professionals. So this endowment and foundations have huge corpus, and they are, if you get any of these investors, they are one of the largest institutional investors. Clear? It is said that collectively, the endowment funds in US is more than $1 trillion. Clear? Everyone? So before you put your hard-earned money into Harvard, Stanford, Kellogg's, Wharton, and whatsoever, you need to know that these institutes have huge corpus with them for their. That's the reason why they have superb amenities in their universities and all. Correct? Now, even in India, we have colleges which are having huge corpus with them. That's the reason why you see in India, the entire education system, like schools and colleges, are mostly run by common man? Of course not. They're mostly run by politicians. Are you getting it? So you'll find most of the schools and colleges affiliated in countries like India with politicians, because that's where huge amount of money is involved. Correct? Everyone?
Yes.
Now comes the another type of institutional investors, which are banks. Why banks are institutional investors? Because banks have huge excess reserves at times. Excess reserves, those money which is beyond what they can give loans. So they have excess of this money lying idle in their accounts. If they don't invest, they will lose out. Why? Because they have to give money to the depositors. They have to pay interest to the depositors, right? So whatever money they could not give as loan, they have to invest it somewhere. But will they invest in high yield bond or risky instruments like equities? Will banks invest in such securities?
Less.
Of course not.
Not.
Will not invest in risky investments. right? Banks will invest in short duration fixed income instrument like money market securities, which will give them even if lower returns, but they will provide them safety and liquidity. So banks are one of the unique type of institutional investors that they will give you huge corpus to invest, but their money has to be in the liquid and safe securities. Liquidity is paramount for them. Clear? Correct? Then you have insurance companies. Insurance companies, what is their business? They collect premiums and in return, they provide claims to the policyholders, right? So insurance companies also have high liquidity requirements. They have to consistently repay the money for claim providers. So therefore, the risk characteristics of institutional investors like insurance companies and banks is almost similar, right? So to pay claim to the policyholders, regulatory guidelines maintain that insurance companies should generally invest in less risky, that is conservative portfolios of fixed income securities. So most of the insurance companies, they invest their funds in investment grade bonds, correct? Right? And then you have sovereign wealth funds. What are sovereign wealth funds? These are national funds created by the government, which they can use to diversify their economy. Correct? Sovereign wealth funds are state-owned investment funds or entities that invest in financial or real assets. For example, what are the world's biggest sovereign wealth fund as of now? Government pension fund from Norway, China Investment Corporation, ADIA, Abu Dhabi Investment Authority, Hong Kong Investment Authority. You have several: Kuwait, Qatar Investment Authority, Temasek from Singapore, and you have PIA from Saudi Arabia, and so on. Correct? You have many Chinese state-owned fund also, which goes out and buys oil, oil-related investments. Like they do investment in oil fields. They bid for auctions of oil fields and all. That's what they do. Correct? So state-owned fund has money which they can use to buy physical assets or buy financial investments. For example, Qatar Investment Authority, it is said that in London, they have more properties than the Queen of England. Can you believe it? They have too many apartments which they have taken in Manhattan, in Singapore, in Hong Kong. So Qatar Investment Authority has invested in stadiums. They have invested in so many different things beyond their country so that they can diversify their oil money. Clear?
There कोई fund नहीं है sir.
No, we do not have a sovereign wealth fund in India, but we have companies specifically for that. For example, we have OVL, ONGC Videsh Limited. It's not a sovereign wealth fund, but it's you can say an arm of ONGC which goes out and bids for offshore and onshore oil field projects outside India. So we have specific companies for specific objective, but we don't have wealth fund which diversifies investments abroad. No. Okay. In fact, if you would see here, there is no US wealth fund. You won't find US, Japan, or UK having a wealth fund. They don't require.
Why?
Yeah, sorry.
Why?
Because see, here, in many of these countries that you see, most of these countries that you see here are either, for example, government pension fund Norway, it's a pension fund. So it's the government's pension fund which they have diversified. And Norway is a country which is very rich and with very less people. So their per capita income is high. So they can probably put their money into risky investments or they can put their money abroad. And they do not probably have too much of an opportunity to invest in their own country. So they have to do that. On the other end, if you look at China, if you look at Abu Dhabi, if you look at Kuwait, if you look at Saudi, most of these countries, I'm not saying all of them, but most of these countries have the government which is more controlled by a particular family or a particular group of people. So there the government funds are not specific to the government only, but they also belong to the royal families. Correct? So the royal family has more control over it. So it's like having your own private equity, having your own private fund for investments. And I have been reading about this sovereign wealth funds, ever since I did my CFA, I started my CFA in 2009. That's where I first time heard about all the sovereign wealth funds. Although I knew in bits and parts, but in much detail at that time. And I used to always think that, wow, these are sovereign wealth funds. See the amount of investment. They have trillions of dollars of investment. Fortunately, in 2020, it's a dream come true for me that I was teaching at the headquarters of Adia. So everything is possible. I'll share you all pictures that, that view from the Adia office, which is right in front of the beach, Cornish Beach in Abu Dhabi. The day I landed up there, I was just having that moment of my life that, 10 years back, I was reading about this company. Wow, what this company must be. And there was I, 10 years after, I was teaching in that company. So, I can't just express you that the pride that I had of doing CFA and completing it, and the place that I had reached from 10 years back to where I was reading up, and I can literally say I was fantasizing about these companies, and here I was with the company. So it was that type of a moment for me. So yeah, that was an amazing feeling. And you know what, you all can probably achieve the same thing. I was a very average student. So life is all about hard work and luck and coincidences and, right decisions with luck flavor into it. So that's what it is. So I had the privilege to work with the $600 billion fund, Adia. Correct. And I interacted with their employees because I used to deal with them while I was teaching CFA. And it was a completely unique experience. And overall dealing with the Emiratis was completely different. And I realized that they launched this sovereign wealth fund in the 60s and 70s. Can you believe that? So in the 60s and 70s, when people did not even have the idea of what should be a sovereign wealth fund, they realized that they have been getting too much of oil money. So they need to create a different investment company to manage this money. Can you believe that? So that was the idea by their king at that time, Sheikh Zayed. So I think it doesn't require you to have a finance degree to come up with such visionary thoughts. No one would see that what Dubai or the Middle East has become now in the last 20 years. No one would have imagined a desert turning into a city like Las Vegas, right? That's all has happened because of the visionary, because of the oil money, but not only because of the money, but having a vision to invest that money in that way, right? So I think it's a tremendous and incredible step of setting up a sovereign wealth fund. And the Middle East companies were the first one to come up with this idea. So that's a remarkable, I should say, a trend that they started, and now that has become a trend in not only Middle East, but in various other countries of the world. Clear? Everyone? Correct. Anyone, any questions? Anyone wants to work with any of the sovereign wealth funds? I don't have any connections. Even I would want to work with them forever. Okay. Yes. Just imagine you are one of the portfolio managers at sovereign wealth fund, and the size of money that you are going to take decisions about. That's the power that you have. A power much higher than the
economies of this.
Economists or politicians. The first day, my colleague, when I entered into the Adia office, I met a guy, a very fair and thin guy, a very normal looking guy. And he greeted me, which is a typical greeting there. They greet you with Assalamu alaikum. And so I greeted him. And then my colleague said, "Did you know who did you meet?" I said, "I don't know. You just let me meet someone, and I just met." And he was a simple guy, right? So he said that, no, he's the, son of the king's brother. And I was like, oh my God. So he's the son of the king's brother, and he's such a simple guy working in that Adia as a normal employee. You would not see security guards with him. You would not see employees rushing with him for serving tea and all. No, that was not the culture. He was like a common man. He was in the coffee shop. He was taking his coffee and all. That was something amazing. I have seen these guys having simplicity. They don't drive, they may be having fancy cars, but I have not seen them driving cars with tons of securities behind them. No, I have not seen that. So I've seen the royal prince and the kings out there, and I never saw them with a fleet of 20, 30 cars, which you see out here. Okay. That's not the case in those countries. And if you see their dresses, pure white dresses, plain dresses. So no show off. I think that's what we need to learn. Having wealth and no show off. And, trusting so much to immigrants for their skills. Here in our country, we don't even trust the people from other states. So I think there's a lot to learn from whenever you travel abroad. You always learn something. I've always seen, and you need to implement that whenever you have a chance to. Otherwise, we won't grow. So exploring the world always adds up. Exploring different culture always adds up to your way of thinking also. Clear? Everyone? Yes. So I'm sure Deepthi must have seen a substantial change in her behavior now, and the behavior and the things around, and her perception must have changed, because I know Deepthi 10 years back and now from India moving to Canada. I'm sure that must be a drastic change in the way you behave and all now, or the way you see things. Am I correct?
Yes.
One of the things that happened with me, it's a joke that, when I was in UAE, for my teaching assignment, so at that time, I saw people, and this is what is very common. I'm sure everyone would be seeing that when you drive abroad, people are following all the rules. People let others, walk the street. You wait for them. You greet them. You don't cross the, that particular line. You don't jump the signal. You drive in discipline and all, in a particular discipline and all. You're a good boy, basically. But that changes all of a sudden when you land in your country back. Here you start honking. Here you start jumping the signal. So I had, completely changed my driving pattern when I came back. I have driven in Croatia and other countries. So there within a couple of days, I realized, wow, I need to change. This is how people drive. So then I came back to India and I started changing my driving pattern. And then I realized people were so irritated of me at the signal and all. They started honking me and pushing me. And then I realized that if I wait for everyone to cross, I will never cross. So I came back to my basics. So these are all, few aspects that you change. When you go abroad,
Yes.
you walk on the zebra line, right? But
Yes.
when you're not abroad, you don't care a damn about the street signal or the cars passing by. You think the road is yours. So there's a very cultural shift.
Because the fines are also very high.
Not just because of fine. You have a lot of fines in our country also, but we have that attitude that it's okay.
Yeah, very true.
If we don't have fines, just check the laws. There are fines even to be standing on the footboard of trains. But if you don't stand on the footboard, how would you get into the train? There are so many fines for even, not walking on the zebra line. We have that law, by the way. But do you think people are going to, even the government knows that I can't go on implementing law at such a micro level in a population of $1.4 billion. So that's not possible here. So anyways, because we always, blame the government that you first create an infra to ask me fine. So
Yeah, but the thing is that there is also corruption plays a role here too. Like if there is a fine, like 50%, you can say, like, if there is a fine, then half of the money, that it goes in the pockets. Like,
I know, but I'll be very honest with you, and don't take me wrong. I don't hate corruption, because as per the law, if you jump the signal, you have to go to the court, you have to fight a case out there, you have to give away your car, and you have to go to the long process. So if you're very honest, in India, when you jump the signal, tell the particular traffic officer that, no, I want the country to be perfect. I want me to be perfect. Let's go to the court. Will you do that? Or will you tell the traffic
No.
officer, just, whatever is the penalty, let me go. This is what we do, right?
Yeah.
We don't have time. That's the excuse we give for everything that we don't want to do or we can't do. So as per the law, don't pay the penalty. Go and fight it out in the court. Would you do that for jumping a signal? You would say, am I such a, do I have such a time to do that? Let me just give 100 and just, exit. Correct? So I think you want strict laws. And when the laws are so strict, you get so scared of them that you find an escape route for it. So that's not how it works. So I don't think corruption is wrong, because if, in a country like us where even for college forms, you have to stand in queues, even for school admissions, you have to stand in queues, and then there are reservations. And unfortunately, if you're not in that reservation category, you probably will never get an admission and all. So either you need to have money or you need to have reservations, and all these factors are so daunting in our country. The law itself at times, pulls you back. So I don't think so. If there was no corruption, I don't know whether I would have got the admission into school and so on in the initial stage. Later on, what? Of course, we become enough capable of not needing corruption. But at a very high scale and at a very low scale, people do not have the means to. At the very low scale, people do not have the means to fight with the system, and at a very high scale, I think they have a means to manipulate the system. But the middlemen, the middle class like us, we probably are harassed with the corruption, but we are also equally responsible for it.
In India, corruption is the key to get your things done.
That's what I'm saying. Corruption is what we in India call that word jugaad, right? If things are not corrupt, then how would you get your work done? We have to fight for everything. Yes. You can't fight with the system for everything. We have to escape the system for getting our jobs done. So that's how we have nurtured corruption into our system. And now that corruption has become a giant dinosaur, which is bigger than us. So I think it's our baby, which has become bigger than us. Okay. And I still don't think corruption will go out from the economy. And it doesn't even go out. It's the scale of corruption that hurts the economy, which is more important. For example, you think the developed nations don't have corruption? Well, they have corruptions at very high level.
Very high level, yes.
You may not feel it, but
absolutely
it's eating you.
Yeah.
It's eating your taxpayers' money. Banking fraud, all these banks, they get huge bonuses and then they default. And then that is being bailed out by the government with the taxpayers' money. You will say that, oh, I did not give anything, but your hard-earned taxpayers' money is going into that, is going into someone else's pocket in a much systemized and organized manner. Even that's corruption. I think, corruption is hurting. Some people see it, some people don't see it. A lot of times I feel if you get stuck in India because of some issues like accident or let's say some unfortunate things, at least in a country, you have a system where you can even escape. If you get stuck in Middle East or if you get stuck in foreign nations, trust me, you'll never be able to exit. There's no one to help you out unless and until you are a US national. Are you getting my point? So at times it feels better that, oh, I was stuck into this problem, but thank God I was in India. Otherwise, I would never be back.
Yes.
Correct. So I feel our country is good and more flexible. They accommodate everyone.
Yeah, maybe because of that, nobody wants to take that much risk. So they are just very much in a decent way when they're outside India.
Correct. So in poor and developing countries, the middle class suffers with the corruption. And in rich countries, trust me, everyone suffers with the corruption, but they don't see that. No wonder US has today one of the world's most homeless people on earth. And US banks are rich. US tech companies are rich. So that gap is, if that's not corruption, then I don't know what that is. Okay.
Yeah, and as you said, it's just the corners of the United States which are
Yes,
like rich.
East Coast and West Coast.
East Coast and West Coast, yes.
If you escape that East Coast and if you exclude those outliers, I say,
The outlier, yes. Yes,
then the population concentration in the center is poor,
poor, yes.
right? That's the unfortunate thing. Okay. So again, even I think that's corruption if that's the case then. Okay. So now we'll move our attention to pooled investment. What is pooled investment? Well, these are institutions which pool or gather money from people and then they invest on their behalf. Mutual funds, exchange traded funds, pension funds, they are all pooled investments. But here we are going to specifically talk about MFs, mutual funds, exchange traded funds, separately managed accounts, which are also called as private banking or privately managed funds. Then we are going to talk about hedge funds and private equity funds like buyout or venture capitals. Let's talk about them. Just to remind you all that when I am talking about hedge funds and private equity funds, we are just going to talk very little about this year because we are going to talk in detail and analyze them in detail in alternative investments. So this part is exclusively repeated back in alternatives also. Correct? So let me first start with mutual funds. We all know what is mutual fund. It collects money from people, right?
Yes.
It collects
Yeah.
money from investors. So I'll write investors' money is being pooled by this mutual fund companies, which are called as AMCs, asset management companies. Now, these asset management companies invest in securities. And the securities generate returns, which is then passed back to the investors. Therefore, this structure is also called as pass-through structure, where investors' money is pooled by the asset management company. They invest in the security generate return. The AMC deducts their fees and passes back the remaining amount to the investors. That's why they are called pooled investments. Clear? There are two major types of mutual funds, open-ended and closed-ended. Open-ended mutual funds are those, like the name itself suggests, they are open, which means you can buy them at any time, even after the NFO. What is NFO? NFO is the IPO of mutual fund. When the mutual fund is first issued, it's called new fund offer. So open-ended fund, you can buy and sell from the AMC, asset management company, at any point of time during its life. That's called open-ended fund. So there's no restriction on entry and exit. That's why it's called open-ended fund. Clear? So you buy and sell with the AMC at a price which is what we call as NAV, net asset value. Clear? So every day the AMC calculates the NAV, publishes that, and at that price, you can either buy or sell the funds. Clear, everyone? That's called a open-ended fund. On the contrary, what is going to be a closed-ended fund? Closed-ended fund is a restricted fund where you cannot enter into the fund after the NFO, or you cannot exit the fund before the maturity, or both. Both means the entry and the exit both are restricted, limited. That's called a closed-ended funds. So how can someone exit from such a fund? If the AMC is not going to buy and sell it back at NAV, where should I go if I am in the need of funds? Where should I go?
Exchange.
Yes, you will have to find someone on the exchange. So closed-ended funds are also traded on exchange. That's like an exit window for you. But tell me, on exchange, when someone goes desperately to sell the fund, will it be sold at NAV only? No. There is a chance that because you are desperate enough to get the money, you may sell the fund at lower value also. So in closed-ended funds, the NAV, which is the price decided by the mutual fund, and the exchange price may or may not be same. Is that clear? What do you think most of the funds in the world are? Are they open-ended or closed-ended?
Open-ended.
Most of the funds are open-ended funds because mutual funds are for middle-class investors mostly. Mostly mutual funds are for average or not too high net worth individuals, but they are mostly for people like you and me. Correct?
So the ETF are like similar to.
I have an entire page to discuss about ETF. and just allow me some time to just discuss
Okay.
about
Okay.
mutual funds. I'll discuss about ETF. I'll discuss about the difference about ETF and mutual fund also.
Okay.
Right? There is a difference, but just understand the mutual fund structure now, and then I'll come to the ETF part.
Okay.
Minor difference, but yes, I'll come to that part. Okay. Now, what are the different types of mutual funds? Well, mutual funds collect money from you and invest in securities. So the mutual funds which invest in money market securities, where you have low risk and low return, they are called money market mutual funds. Mutual fund which invests in bonds, like short-term or long-term bonds issued by government or corporates or any particular bond, they are called bond mutual funds or debt mutual funds. Here in debt mutual funds, the risk and return are on an average. Equity mutual funds are the ones which invest in equities. They can invest any equities which can be domestic or global or emerging equities, which can be managed actively or even passively. Like equity index funds are those which are passively managed funds. Equity active managed funds are those who invest in large cap, mid cap, and diversified stocks. There, the risk and return both are high. Correct? So money market mutual fund, they invest in CDs, CPs, T-bills, and so on. Right? Bond mutual funds, they invest in bonds of corporates, governments, and various entities. And equity mutual funds, they invest in different types of equities. Those who want the flavor of both equity and bond, they invest in hybrid mutual funds. Hybrid mutual funds do not invest all their money in one asset class, but they invest in various asset class. Mostly they have debt and equity, but in few cases they can also add gold or any other asset class as just adding the diversification aspect, right? Clear? Hybrid mutual funds are relatively safer. Their returns are higher than bond mutual funds, but not as high as equity mutual funds, and they are relatively better than investing directly into equities. Yes.
Can it have like high yield bonds too?
High bond scheme means
High yield bonds, like hybrid.
yes. See, in hybrid, whether it's a hybrid mutual fund or it's a bond mutual fund, they don't invest in one bonds. They invest in 20, 30, 40 bonds maybe. So they may have a combination of risk-free bonds and risky bonds. In that, having 2 or 3 high yield bond is not a problem in a big portfolio. So they're very prudent in their investments. They do invest in high yield bonds. That's how they will generate alpha. That's how they will generate excess returns, right? But then again, as I said, the risk and return will go in tandem in such a case. It depends on how well they diversify. That's how they can probably reduce the risk. Clear?
Yes.
Now I'm just showing you the picture from a particular statistics. Venture Capitalist, that's a website that has particularly updated the statistics. Like in US, majority of the funds are in domestic equity funds, right? As in the case with the various other countries, bond funds, then global equity funds, money market funds, and very few in hybrid funds. So if you check here, US is more of, they have a tendency more to invest in risky assets, correct? Here I've put the world's largest asset management companies, and you would find there the first largest companies, and there's a good race between the first and the second one, that is Vanguard and BlackRock. BlackRock Group is the world's largest asset management company. In India, we have DSP BlackRock, which is an association of DSP and BlackRock. In India, mutual fund companies were not completely operated by foreign companies. So now they started an association with domestic investors. So that's why you have Birla and Sun Life, you have ICICI and Prudential. They're both not the same company, by the way. So that's how you have investments in countries like India, where direct investment by foreign group is not allowed. But otherwise, global investors like BlackRock, Vanguard, Charles Schwab, Fidelity, State Street, these are one of the world's largest asset management companies. And you can just see their asset size, $9 trillion. That's more than so many economies, right? India's economic size is of GDP, how much? $3 trillion at max. So 3 times the size of India's economy is the fund that BlackRock alone manages. Can you believe that? Okay, that's the size of the investment by one particular AMCs. Country-wise, which is of course the world's highest investment country in terms of mutual fund, it is US. Then you have Luxembourg. You know why Luxembourg? Luxembourg it's a big country or a small country? Very small. Luxembourg and Ireland, why? Because they have a lot of tax incentives to start up the companies there. So you have many of the firms which are registered in such offshores. Germany, China, France, Australia, they are also one of the biggest, investors in mutual funds. Unfortunately, you would not find your country there. We would not find India out there, because we are still having good amount of investment in mutual fund, but not as much as what the global investors have. So I see huge opportunity in investments in mutual funds in India still there. You know, those ads that you see on the TV, right? Of mutual fund exclusive, too many ads, you know, that's contributing to the investment, but still there is enough of penetration and potential. Clear? Just for your reference, I've added this particular charts. Everyone clear with mutual funds?
Yes.
Now in mutual funds, when you had to buy and sell the fund, you had to go to the, assuming it's an open-ended fund, you had to go to the AMC, and there you had to buy and sell the fund at the value that the AMC declared. That is NAV. Unlike that, exchange traded funds, by the name itself, they are mutual funds which are traded on exchange. So you can easily buy and sell them on the stock exchange. Is that clear? That's a unique feature of ETF. So ETF is not, it's a hybrid security. It's like a mutual fund, but trades like an equity on the exchange. Correct? So you can at any time during the trade, during the date, you can buy this ETF, you can short the ETF, you can do anything with the ETF like what you do with a normal security. Correct? Most of the ETFs are passively managed. What do I mean by that? They collect money from you and then they create a portfolio which replicates the index. S&P or Dow Jones, they replicate a particular index. Then they just passively buy and hold the investments. So your returns will be equal to the index returns. Clear? But you don't have to wait for the AMC to redeem your money. You can just sell it on the exchange. Is that clear? Right? So this part of easily buying and selling the funds and replicating the indexes or a benchmark is what is unique feature of ETFs. ETFs are created by the fund sponsors, which is the one who launches the ETF, who determine which securities will be included in the basket. Correct? Now, how does an ETF get created? The supply of ETF shares is regulated through a mechanism known as clearing and creation and redemption. It involves large specialized investors called authorized participants. So your authorized participant is the one who is going to deal with the stocks. Now, the AP buys shares of the stock from the index and sells them at a profit to the ETF whenever the ETF wants to issue additional shares. So now, let's say I'm planning to create an ETF. So ETF will do what? ETF will sell shares to the investors, right? Correct?
Yes.
These shares will represent what? They need to have something to represent, right? Why am I selling shares? Against what? Against a portfolio of securities which I will buy directly from an authorized participant. An authorized participant can be a bank or a broker. Let's say Goldman Sachs is an authorized participant. So from Goldman Sachs, I'll call Goldman Sachs and I'll tell that I need $100 million of S&P 500 securities. Get it for me. So Goldman Sachs will buy 100 million securities for me, right? They will buy these shares and, based on these shares, the ETF creator will create the ETFs. Let's say the portfolio is $100 million. I'll create every unit of, let's say, $10. So I'll issue 10 million securities to the investors. So the investors have bought from me the units, but I have been there. I have put this money into the portfolio of the index, which is managed by Goldman Sachs. But Goldman Sachs will just hold it because it's a passively management. Clear? So think of this. The AP, the authorized participant, which I said is Goldman Sachs here, buys the shares of the stock from the index and sells them at a profit to ETF whenever the ETF wants to issue additional shares. So now if I say Goldman Sachs that I need $100 million more of securities, Goldman Sachs will buy for me $100 million of securities. Let's say they buy at $20 and they will charge me $21 because that's a brokerage that they will charge me, right? Now,
Yes.
against that additional 100 million, I will issue more shares. Clear? Everyone understands the system, how it works? So who buys the shares on behalf of the ETF sponsor?
Authorized participant.
The authorized participant. How will they make money? By buying security on my behalf and charging me for it. What will the ETF creator do against the securities? They will issue more security. They will issue units to the investors. Clear? What is the benefit to the investor compared to the mutual fund? What is the benefit? In the mutual fund, if you want to sell the fund, you will sell that to the AMC, and the AMC will have to sell that from the portfolio, right? Correct?
Yes.
But in ETF, when you want to sell the fund, you don't have to sell it to me. You can sell it to another buyer on the exchange. Are you getting my point? Correct? So that creates more efficiency. The overall fund is not hindered or not impacted due to the redemption. That's the unique part of ETF. Clear? ETFs are, yeah, sorry, go ahead.
So in a way, if we look at the ETF, we kind of say it's an expensive form of the equity.
Okay, you can say, but you know what? If you yourself had to buy, let's say S&P 500, it would be so complicated and difficult for you to replicate an index, like buying 30, 40 or 50 stocks. And what if you have only $100? Can you buy this 30, 40, 50 stocks? No. But with the same money, you can buy an ETF. So you are actually getting diversification at lower cost and lower value. So it's not an expensive version. Rather, I should say it's a much better version because you're getting diversification at lower cost. That's why ETF, sorry.
Same will be with the returns, right? Of the returns will be average.
Yes, the returns will be equal to the index. And let me tell you, in the last 5 years,
6%.
the index has given more returns than the individual securities. And that's why, if you recollect the topic that I had done with market efficiency, where I discussed that why Warren Buffett is promoting more of investments into ETFs. So just see the global ETF investment. Where has it moved? You recollect that? Right? I had also added largest ETFs in 2021 year. Correct? So there is an extensive money invested in ETF. Why? Because they're getting better returns. Are you getting my point? So we've discussed about ETFs, largest ETFs by market cap also. That's what we've discussed in the topic of market efficiency. So contrary to the belief that ETFs give less return, in fact, ETFs have been giving substantial returns. So the investment has been just increasing day by day. Clear?
So their net asset value is ETF's net asset value is
same as
closer
mutual
to
fund. It's same as mutual fund, but the advantage here is that they are not exchanged with the NAV, with the AMC. Here, the AMC will not process your redemption. You have to sell that fund on the exchange. So it may look like a closed-ended fund, but closed-ended funds are mostly debt funds. They are for limited period. And closed-ended funds are very much sold at discount because you are unable to sell them. But
Yes.
ETFs are not sold at discount. They are mostly sold at premium on the exchange because they are in high demand. Okay. For ETFs, the exit window for an investor is the exchange only. In the closed-ended fund, if you wait till maturity, you can exit with the AMC. But that's more like a distress selling before maturity. ETFs, that's not the case. Okay.
Okay.
So I actually got a very good diagram, and I have not created it. I got a very good diagram from a particular website, and then that's where. So I've put up here the basic difference between mutual funds and ETFs. I hope this helps, and then I'll go to that diagram. So buying and selling of mutual funds with the AMC, but in ETF on the exchange. When it's a mutual fund, it will be trading at NAV, but in ETF, it will be traded at the exchange price, correct? In mutual fund, if I have to exchange on NAV, it just happens on the close of the business day, just once. But in ETF, guys, I can trade throughout the trade, right? Throughout the business time. Which one is more expensive? Mutual funds are relatively more expensive because they are actively managed. The fund manager does a lot of hard work there, right? To source that alpha. But ETFs are passively managed, so their cost is very low. Hence, the transaction cost or the brokerages are the transaction cost is very low when it comes to expense ratio. Sorry, not transaction cost, expense ratio. That is the cost to manage the fund is very low in a ETF because it is passively managed compared to mutual fund, which can be actively managed also. But remember, to buy and sell the mutual fund with the AMC, you don't have to pay the brokerage, but to sell the ETF, you will have to pay the exchange brokerage. Correct? So in that way, the brokerage is there in ETF, but not on mutual fund. Correct? Everyone? Yes. That's all the difference. And then you have a very good diagram for difference of mutual funds and ETF. And the center one is the intersection, the common part between both. Any doubts, anyone? Yes. Now let me know whatever doubts you had about ETF.
So the ETF can be created by anyone. It's like a basket of securities which can be have a cumulative value and which can be traded.
Sorry, ETFs can be created by?
It can be created by anyone. Like let's say,
Any institution can create an ETF. Most of the AMCs, they have their own ETFs. So ETFs can be created like you, for example, the largest ETF which I just showed you, and that is created by whom? I'll just show you that again. See here, sorry, where is it? Yeah, market efficiency. What is this? S&P. S&P is the company, the rating agency, right? They also have their other businesses, and they do create indexes and ETFs. So you won't find here only asset management companies. You'll find here other companies also. iShare. You'll find Vanguard and other, but there are various other investors. They create ETF. For example, in India also you have S&P 500. You have S&P Dow Jones. We say S&P CNX Nifty. Correct.
Yes.
So it is managed, that index of Nifty. Of course, that is created by NSE, National Stock Exchange of India, but that is operated and managed by S&P. Are you getting me? So then S&P can go ahead and, because they have the royalty, you can say, for the index, they can create the ETF. They can just seek out the permission from Securities Exchange Board and they can launch up their own particular index. So you have to meet the regulatory guidelines and then you can also launch up an ETF. I think Motilal Oswal in India, which is a broking firm, they have their own ETFs also and they have their indexes. In fact, the financial newspaper like Economic Times, they also have their indexes, ET index. So they've registered that indexes. You can also individually do that. There's no harm in it. I mean, just that there should be enough buyers for your ETFs. Okay.
Okay.
Yes, anyone, any questions with respect to ETFs or mutual?
So REITs are a type of ETF, right?
REITs are type of ETFs, but exclusively they invest into real estates. Okay. In level 2, you have entire section on REITs. In level 2, they have, unfortunately, they're not kept in level 1. They have something, I think, some minor discussion in alternative investments, but otherwise in level 2, you have a substantial topic dedicated to REITs. In India, you have REITs and InvITs. InvITs are infrastructure investment trusts. So those are also, now they are becoming famous, but you know, in the subcontinent, like in Asia, Africa, and the Middle East, REITs are not that famous. Why? Because your people still prefer to directly invest in real estate than indirectly having exposure through REITs. It's very common in US and Europe and North America, but not that common in the subcontinent here, because we have easy access to leverage for home loan. subsidized rates. So that's the reason why people directly prefer physically buying an investment than having indirect exposure through REITs.
Are there any ETFs for Bitcoins?
I think there was ETF for Bitcoin. I don't think so. No, I don't think so. There is ETF for Bitcoin as of now, because most of the Bitcoins are very illiquid in terms of trading. So I don't think so. There is it's difficult to create an ETF on a Bitcoin, because you know what, the price volatility that you see of this different types of cryptocurrencies is severe. So it's difficult. But there must be. I probably don't know enough about it. Not at least the ETF part. Okay, everyone?
Yes.
Now, another type of pooled investment is separately managed accounts. Separately managed. Now, mutual funds are for everyone. They have a common objective for everyone. So I am just one of the investors in mutual fund. I can't tell the fund manager which stock to buy and all, right? I don't have that power, because like me, there are several investors. But if your net worth is of billions of dollars, you can have your own mutual fund. You can have your own fund manager to manage your own account. That's called separately managed accounts. These are more like private banking or a private fund management for selected group of investors or family or high net worth individuals. So fund management service for institutions or individual investors with substantial assets like HNIs is called separately managed account, which is commonly referred to as managed account, wrap account, or individually managed account. Why am I using this alternative names also? Because when you do ethics, you will come across this terms called wrap account. Wrap account is privately managed funds. Okay, wrap accounts. In many countries, we call that as private banking or wealth management, right? For HNIs. Is that clear? A separately managed account is an investment portfolio managed exclusively for the benefit of individual or the institution. So here, can I say already that the individual and the institution will have more power on deciding what to buy and what to sell? Correct?
Yes.
Because here my focus is not on the overall investors, but on that particular investor. So my portfolio will be more customized to cater to the needs of clients' IPS. Correct? So here I will take into account the client's investment objective, risk tolerance, tax situation, and accordingly create a portfolio. Compared to mutual funds, in mutual fund, am I the owner of shares directly or the owner of mutual fund units?
Mutual fund units.
Mutual fund units. But in a separately managed account, I am the owner of the share and I have just kept someone to manage it. So that's a very big difference. In a separately managed account, the individual shares are held directly by the investor in their name. And in return, the managers, they charge me annual fees. So an individual can receive personal investment advice because the fees are relatively high than a mutual fund. In mutual fund, the fees get split between various investors. Here, you may have to incur high fees, but then you get the benefit of customization. So if it's your family office or a fund of billions of dollars, then it makes sense to have a separately managed account. Clear? So the biggest difference between mutual fund and separately management account is the way they invest. So the important difference is that MF investor owns share of the company. In turn, what happens in a mutual fund? Investor owns units of the mutual fund companies who holds the shares. But in a separately managed account, investor directly owns the shares in their own name. Are you correct? Am I correct, guys? That's the biggest difference here. So here, I will have a more customized portfolio. I will have a more, dedicated portfolio of focusing on my IPS. But there is also a chance of very high fees. Clear? So of course, the fund size has to be enough to manage. That's called separately managed account. Everyone with me on this? Correct?
Yes.
One name that I would like to suggest here is companies like HSBC are very well known for running wealth management, private wealth management. They are very well known for separately managed accounts. Okay. UBS, HSBC, they are quite famous for all this thing. And they also have a very defamed status for managing black money or siphoning of funds, illegal funds and all. So they do all those types of, I'm not blaming them, otherwise they'll sue me, but there are several penalties on them by the regulators in the past for managing such funds. In fact, many of them, I don't want to name them officially because we are recording this, but many of them have also been found guilty of funding the Iranian corporations who were later found out to be funding terrorists and banned organizations and so on. So there's a lot of mess around with that. And we in India also have a lot of politicians siphoning of money from here with the help of many of these high profile investment banks in the name of separately managed accounts. You're getting it? Panama Papers was just one of the tip of that iceberg that you probably have seen. Okay. Then you have hedge funds. Now, hedge funds and private equity funds, as I said, we are going to discuss that in length when we do alternative investments. So I'll just quickly do here. Hedge fund is like mutual funds, but the group of investor is small and they do not have to give information, or they do not have to take permission from the regulators to decide on where to invest or all. So they do various risky investments. Hedge fund strategies generally involve a significant amount of risk in large scale, and they use leverage, they use derivatives, they are very complicated. They put their money unrestricted, they put their money wherever and whenever they want. They don't have to take the regulatory permissions as much as the mutual funds have to do, because the mutual funds deal with public money. Hedge funds exclusively deal with money by group of people. So they gather together, and one of that person can be the lead investor, and then they decide on their customized strategy where they have to put the money. Hence, the biggest difference between hedge fund and mutual fund is the amount of risk that the hedge fund takes and the amount of flexibility that the hedge fund has, right? So key difference is the vast majority of hedge funds are exempted from reporting requirements. They don't have to report to the Securities Exchange Commission as what public investment funds have to do. The net effect of this regulation is that hedge funds investor base is generally very different from that type of mutual funds. So mutual funds, mostly people are, individual investors planning for their retirement and all, but hedge funds, people are putting their risky investments, people are putting their money for betting on risky investments, and hedge funds are very risk-taking funds. They are probably the most aggressive part of mutual funds for selected individuals, you can say. Now, hedge funds therefore have more fees than the mutual fund. Mutual fund, the fees are generally regulated or fixed. That's the fee that the fund managers charge to the investors. But in hedge fund, the fees can go as high to as 1 to 2% of the total corpus, total asset under management. Plus, they also have an incentive that if the fund crosses a particular benchmark or crosses a particular ball mark, then the investors will also have to give out incentive to the fund. Correct? This feature of incentive is not with the mutual fund, but it is there with hedge funds, which puts the hedge funds to take more and more risk. Is that clear, everyone? Right?
Yes.
There are various types of hedge funds. Emerging market hedge funds, the name itself will tell you where they invest. Equity market neutral. So they buy one equity, they sell another equity. So they do short selling also. They do derivatives and short selling exclusively. Remember that. Event driven, they put their money when they expect some big event like M&A and all. Fixed income arbitrage. Global macro, they invest in wherever they find there will be a global event coming up. Long short, they buy and sell securities. Convertible arbitrage, dedicated short bias. These are hedge funds which focusing on shortening. They focus on doing shorts. Mostly during the subprime crisis, there was various hedge funds who were doing short of securities, mortgage-backed securities, because they were falling and they made billions of dollars with that. So of course they may make billions of dollars and they may wipe off also suddenly. They may also suddenly collapse. So hedge funds, you will never find consistency with hedge funds. Many of the hedge funds which are famous today may not be there after 2-5 years or 10 years, because they take so much of risk that they may suddenly get evaporated. I've just added a diagram of some of the few famous hedge fund managers. One of the very famous fund managers, which you would often see on TV shows and all, is Raymond Dalio. He's the head of Bridgewater, and you would see him quite, a couple of times you will see him in the investment conferences or investment news channels and all, business channels and all. Then Jim Simmons is also said to be one of the very famous hedge fund managers. I know these two of guys because I have been following a lot of financial news where these guys regularly come and come up with their investment advisories and all. So these are one of the few of the hedge fund managers that you can just go across for your references. Clear, everyone? I've also added a link of the list of the hedge funds where you can probably get to know all the hedge funds which are there, the top hedge funds across the world. You can probably just go through what are the different hedge funds, Bridgewater, then AQR Capital, Citadel, and so many, D Shaw. There are various hedge funds. Many of them, you may also find the names common. Normally, when I do this research, I used to do all this research when I was doing my studies also, not for the reason of studies, but also for the reason where should I put my CV. So I used to try putting my CV in these hedge funds. Okay. So you need to have that knowledge. What are the hedge funds where we can actually put up your CV for jobs? Interesting thing to work in such hedge funds. Okay, everyone.
Most of the
sorry, go ahead.
most of the hedge funds are from US, right?
Yes. US is the mecca for all the financial US. Why is US so powerful? Because of its political might came later on. Its financial might is what, just take out any graph when it comes to finance. US is on the top of everything. Consumption, GDP, every particular data that you want to pull out. US is the top of all, right? Even debt. And now slowly and gradually, China is coming out there in all the fields, whether it's investments, whether it's defense, whether it's any form of, banks or corporates, technology. You'll see China gradually coming to that. So the last entire century was dominated by US. What I think has hurt US more is not 9/11, but it's 2007 and subprime crisis that has hurted US more than the 9/11. Okay, so US has taken a lot of bad decisions, but the collapse of banking system has hurted US more than any other event that US has ever seen, I think. But I still believe US is a land of free people, and I still believe that US, the system that US has, their system, their bureaucracy and all that is tremendously powerful and has tremendous dominance in the world, and they will not let it go so easy. And that is what they now I see dominate through the help of this social media giants. Now, a couple of years back, the tech companies were ruling the US, and they are still ruling the world, not only US. So only many of those companies have now changed from oil companies to now you see Facebook, Instagram. No, instead of oil, I think data is the new oil, and they have all our data. Whether you see Microsoft, Apple, Google, Amazon, they have all the data. Facebook, Instagram, Snapchat. They know everything that you and I do, talk, see, listen, behave. I think they control. Initially, they used to control the financial economy. I think now they control people. They can decide who they want to block. And these companies have become so powerful that they have blocked their previous president also. So if a country like US and a company like Facebook and Twitter can block the former president Donald Trump, that just shows you how powerful they are. They're fighting with all the governments in the world, not only US government. They're fighting with all the governments in the world, and they're paying penalties also in billions of dollars, but still they are running the show. I think the global politicians, they first use the social media to get the power, Now they are worried about the social media, toppling them out. Are you getting me?
Mhm.
So I think US is always going to be the top, on the top. Now, whether it's the US government or now the US company, that's the question. Okay. They
आपकी
won't
बारी
let
नहीं
go.
आएगी सर.
They won't let China take it so easily. Yeah. Tell me.
अपनी बारी नहीं आएगी सर कभी टॉप करने.
Sorry. क्या?
क्या की बारी नहीं आएगी कभी.
Uh, we of course, the day we try to resolve our internal issues, we are of course there. But let's first, deal out with the religious, the regional,
The
and
internal politics,
that's
yes.
what I'm saying. Let's first deal out with the internal issues which we've been dealing from the last 5,000 years. Probably will take another 500-600 years to deal with those issues, and then definitely we'll be there on the top when the world is done. I think I'm very optimistic about it.
Yeah, but after 500, 600 years.
If the world survives, we'll be probably on the Mars and we'll be still fighting out on religious aspects, I'm sure. On the Mars also we'll be fighting out this land belongs to whom. That's what is going to be with us even after the point that we are on Mars or any other planet. So that's what we are, but we are still surviving. I have a hope here that a lot of people say that, on the contrary, that, India is such a messed up country and all. There are so many riots and all this that takes place and all. So I tell them that, in a country of 1.4 billion people it's unfortunate, but having small riots and all, that's quite common. In a home of 4 people, you have fight every
Exactly.
third or fourth day. Then in a country of 1.4 billion, how can you not expect to have fight every third or fourth day? Tell me that. Okay.
Given a proper guidance, our population is going to take over all this.
See, you know what? You're very correct, because we've been studying in our books since the childhood that population is bad. Population is bad. I think that population has worked in favor of China.
Yes, obviously.
So it's not just the population, it's the demography of population that is more important. One important thing, I don't know whether you are aware or not. When did India started progressing the most? What we have all read. And I'll tell you how illusionary things are. When did India started progressing the most? What have we read? We've read that's 1991 after liberalization, right?
Yes.
You know what? In 1991, India and China's GDP at 90s, I think 89 and 90, India's and China's GDP was same. In fact, India's GDP was more than China. Do you even know that? So if we think we have progressed after 1991, just see where China is. And you'll realize that progress is what? Are you talking about our progress with the previous year or with the peers? Just imagine where the peers are now where they were. So I think we need to come out of what is published in the media. So for all those people who say that, yes, India did progress after 91, I don't say no to them, but I just want to say that, have we really progressed? Just see what China has done. We were at the same level. The race was at the same point during the time of liberalization, which we had in the 89, 90s and so on. And where has China gone? It is almost 4 to 5 times of our economy right now. And they have lifted more than half of its population from lower income group, from poverty. So it depends on which angle you want to see. Instead of blaming a particular government or not, I think overall we have economy not progressed as much as what China has. Now, one reason I see here is that time China's demography was that it had highest number of its population in the working age group. Okay. That advantage now we have.
Yes.
There are very few countries like India and Saudi Arabia. These are the countries which has huge population, and majority of their population is in the working age group. So I think in the next 20 years is of India. Why? Because I'm not saying because I'm hopeful about everything and I'm too optimistic. I'm just saying it's technically possible. It's technically possible because a country has progressed the most either after two things, and trust me, you can write it down because this is not in the newspapers. The country has progressed the most in the past after the world wars or at the time when they have a huge demographic change, like having huge population in the young group. Tell me one thing, which was the country which got most disturbed during the World War II? Almost finished. Who are the biggest losers in World War II? Two big countries. Can you name me?
France.
Biggest loser in World War II? Germany and Japan.
Japan.
Germany was attacked by everyone and Japan
Yes.
saw nuclear bombs.
Yes.
Doshi Managasaki.
And just see 20 years after that, where were these two countries? They were already super rich by 1960s. Are you getting me? They were already developed in 1960s and 70s. In fact, in 1970s, Germany hosted the Olympics in Munich.
Yes.
So I think that it depends on where you grow from, how you, countries like Korea. I can go on and on discussing this. Korea, South Korea is a country which was in drought after the war with North Korea. They both were on par. And now you see South Korea is a developed nation. Okay. These countries like South Korea, Japan, you know what they were told in the past? They make copycat goods, like what China was told. Now do you see them? From copycat, they have become tech-savvy countries. And now China, which was accused of having a copycat good makers, right? After a couple of years, in fact, now itself, you'll see with companies like Huawei, they are now going to be the pioneers of the technology. So there's no harm by starting making copycat goods, but later on they transform with that money into technology. And I don't think so there's any wrong with having copycat goods. I just see that when I went to buy a plug for my phone, it cost me so many dollars, but if I can have a China plug and that does my job and I can throw it and I can buy another. So everything that you have around you, most of those things are Chinese. So I think more than, except what happens on the border and what does their governments do, I have tremendous respect for what China does. I think China is right on the path of what Japan and Korea did. So Japan, Korea, what they did, China and Taiwan and Hong Kong are doing the same thing. It's just that they did without political hiccups. China is having more of political issues. So I think that's what they need to sort it out. Otherwise, this can become a mess. Clear? We don't have to worry in India because we are already in a political mess. Clear? So there's nothing bottom from here. Okay. Yes. I think the last thing that I would like to add is that after pandemic, where we have badly suffered, I think the bottom has come. Now we should see a substantial momentum in the economy. In this worst crisis also in our country, we did not see the markets or the stocks go 30-40% down. Did we see that? I don't think so. How long can you hold stocks? Because I think the potential outweighs the risk. Therefore, I think this is the best time for India to, now that bottom has reached, I think now the pickup time is from this point. So I'm very optimistic from the structural point of view. Clear? Finally, let's deal with one more type of investment, private equity. Private equity funds, they are funds who invest in private companies, or they pick up a stake in a public company and make it private. They pick up a huge stake in a public company, delist that and make it private. So that's called PIPE, private investment in public enterprises. Clear? So private equity funds, they pick up a huge stake in a company, substantial stake, and then they control. Correct? Now, I've just added the link, how big is the private equity. I will show you different types of private equity funds after I complete the discussion. There are, within the private equity funds, you have buyout funds. What do buyout funds do? They buy out the entire company, right? They get involved into the company management and so on. So they probably just don't, they just don't invest the money. They actively participate in it. So buyout fund, the essence of buyout fund is that they buy out all the shares of the company, public company, and make it private. But to buy out the company, they may use leverage. So when they issue debt, and with that debt, they buy out the company. Such type of buyout are called leverage buyouts. Clear? So what is leverage buyout? They raise debt, and with that debt, they take over the company. That's called a leverage buyout. Mostly it's done in case of companies which are in financial distress, but their operational profits are good, right? Most private equities funds do not intend to hold them forever. What will they do? They will turn around the company and sell the company when the company turns good, either in an IPO or in M&A, or sell it to a new buyer. Clear? So they are probably the redeveloper. They will come up in the company, they will paint it well, they will restructure the company, they will bring it back to operational profits. And then once they do that with their management expertise, they will sell them off. That's called buyout funds. Clear? Everyone? So their investment horizon can range from 3 to 5 to 7 years. And when the company becomes operational profit, they may exit. But again, they are very risky, because what if the companies don't turn around? Then they may lose a substantial wealth. Clear? Similar to that, we have venture capital funds. Venture capital funds also put money in the companies, but they invest at a very nascent or initial stage when the company is probably a startup. So there, the investment by venture capitalists and buyout, the biggest difference between buyout and venture is that buyouts invest in a much stable or much matured companies. Venture capitals invest in a much startup companies, in much like a startup company. So they probably take more risk, isn't it? VCs take more risk, but they also have a higher potential to invest. Am I clear, everyone? So I've just added few of the VC companies here, which are very famous and my favorites. SL Partners, Tiger Global, IDG, Sequoia, and Kleiner Perkins. Now, I'll just tell you few of the investment, which is what I've displayed here. SL Partners was one of the very first investors in Facebook. They invested in Facebook in, I think, I'll discuss that in the alternative investments also. They invested in Facebook in 2006 by, I think they bought a 10% stake at $12.5 million. And they exited in 2012 when Facebook IPO launched. At that time, they sold their $10 billion. Can you believe at what price? Facebook in its IPO was valued at $100 billion. So they sold at $10 billion. Almost return of 1,000 times in 6 years. Can you believe that? They were one of the first investors in Dropbox, Spotify, Vox Media, Jet.com, Etsy, and so on. These are all, retail companies, basically online. Tiger Global, which is one of the first primary VC investors in Byju's. Byju's, as of today, is India's most valuable startup companies. TVF, the viral fever, the TVF pictures, they basically run like Netflix. They have their shows. So Tiger Global is one of the biggest investors in TVF by Arunab Kumar. Quora, LinkedIn, Facebook, Spotify, Flipkart, and Koo, which is a retail giant. IDG Ventures, they are the first and primary investors in Baidu, Tencent, and Xiaomi, which are all the Chinese super giants now. Sequoia Capital, Apple, they were one of the biggest investors in Apple, Google, Oracle, PayPal. Just imagine, where are these companies now? They were the initial investors. In LinkedIn, YouTube, Instagram. YouTube then was sold to Google. Instagram to Facebook, Yahoo, Pixar, and WhatsApp, again sold to Facebook. So they were the first investors in these companies. Kleiner Perkins was very much focused on retail giants and in the social media. So they were the first investors, one of the primary investors in Amazon, JD.com. JD.com, aware everyone? Again, like Amazon, it's a retail giant. E-tailer, Square, Snap, and Twitter. They were the first investors in this. Clear, everyone? Some of the notable investments by VCs. We'll talk about more of that when we do alternative investments, right? Just for your reference, how big is the private equity market from this particular thing? If you can see my screen, one of the biggest private equity group is the Blackstone Group. Blackstone Group is said to be one of the biggest private equity funds. Then you have the Carlyle Group. The former president of USA, George W. Bush, was one of the members of the Carlyle Group. KKR, Kohlberg Kravis Roberts. That's KKR, which is one of the biggest private equity investors, and they have substantial investments in Middle East, in India, and so on. TPG Capital, Warburg Pincus, they are very, very famous private equity funds. Clear, everyone? So just added the link. You can probably just go through that for your reference. Yes. That's it. That's the first part of portfolio management that we've dealt with. Anyone has any doubts or anything? Yes. Anyone? That's it from my end. You have any doubts, let me know. Otherwise, we'll meet in the next section with a new topic. Thank you so much.
Thank you.
Anyone, any doubts?
No doubt.
Okay, goodbye. Take care. Enjoy.
Thank you. Yes.
Yeah. Bye-bye. Bye.
Bye.